What if I told you that 90% of new investors lose money not because they picked bad stocks, but because they fell into traps that could have been easily avoided? These aren't the obvious mistakes everyone talks about. These are the silent wealth killers that financial advisors rarely mention. After analyzing thousands of investor portfolios and seeing the same patterns destroy potential millionaires over and over again, I've identified the 7 most costly mistakes that beginners make. Mistakes that can literally cost you hundreds of thousands in missed gains. In the next 12 minutes, I'm going to reveal these 7 hidden investing traps, show you exactly why they're so dangerous with real data, and more importantly, give you the exact strategies to avoid them completely. And here's the kicker. Mistake number 5 alone costs the average investor $200,000 over their lifetime, yet 97% of people do it without even realizing it. So stick around, because by the end of this video, you'll know exactly how to sidestep these wealth destroyers and potentially save yourself decades of financial regret. Let's start with the mistake that keeps more money on the sidelines than any other: trying to time the market perfectly. You know the story. The market's too high right now, I'll wait for it to crash. Sound familiar? Here's the brutal truth. A study by the Schwab Center tracked 5 different investors over 20 years, from 2000 to 2020. They gave each investor $10,000 annually to invest. Investor number 1 had perfect timing, bought at the exact market bottom every year. Result? $151,000. Investor number 2 said, "Screw it," and invested immediately every January, regardless of market conditions. Result? $135,000. Investor number 3 used dollar cost averaging, invested the same amount monthly, also $135,000. Investor number 4 had the worst possible timing, bought at the market peak every year, still made $121,000. And investor number 5, the one waiting for the perfect moment, kept everything in cash and made $0. Actually, I lost money due to inflation. The takeaway is crystal clear. The cost of waiting is almost always higher than the cost of being wrong. Time in the market beats timing the market every single time. Now, there is one exception. If you need money within the next 2 years for something specific like a house down payment, keep that in a high-yield savings account. But for long-term wealth building, stop waiting for the perfect moment. It doesn't exist. Mistake number 2 is the silent wealth destroyer that most investors completely ignore: fees. These tiny percentages are quietly draining your portfolio, and most people have no idea how devastating they really are. Let me paint you a picture. You have 2 investment options. Fund A charges 1% annually. Fund B charges 0.04%. You think, what's the big deal? It's less than 1% difference. Wrong. Dead wrong. Over 30 years, that 0.96% difference will cost you over $50,000 on a $100,000 investment. That's not a typo. $50,000. Here's what's even more shocking. Morningstar data shows that only 24% of actively managed funds actually beat their passive counterparts over 10 years. So you're paying premium prices for inferior performance. The solution? Stick with low-cost index funds. Vanguard's Total Stock Market Index has an expense ratio of just 0.03%. Fidelity even offers zero-fee funds. These companies have already done the math. They know low fees are your best friend. Before you invest another dollar, check the expense ratio. If it's above 0.2%, you better have a damn good reason for paying that premium. Picture this. You put your last $5,000 into the stock market because you heard Tesla was going to the moon. Then your car breaks down. You need $3,000 for repairs, and you're forced to sell your investments at a loss. This happens more than you think. Without an emergency fund of 3 to 6 months of expenses, every market dip becomes a potential catastrophe. You'll make emotional decisions, sell at the worst possible times, and pay short-term capital gains taxes that can eat up to 40% of your profits. I learned this lesson the hard way in 2008. Watched people sell everything during the crash, because they needed the money to survive. Meanwhile, those with proper emergency funds, they bought the dip and made fortunes. Here's your action step. Before you invest another penny, build that emergency fund. Keep it boring, high-yield savings account, money market, whatever. Just make sure you can sleep at night knowing you won't have to touch your investments for at least 6 months. Mistake number 4 is investing without a plan. And no, make money is not a plan. That's like saying you want to get fit without knowing if you're training for a marathon or trying to bench press 300 pounds. Your investment strategy should be laser focused on your specific goals. Are you building wealth for retirement 30 years away? Saving for your kids' college in 10 years? Want passive income to quit your job? Each goal requires a completely different approach. Long-term retirement money can handle volatility. That's growth stock and index fund territory. Short-term goals need stability. Think bonds and conservative investments. Here's the 80-20 rule in action. Focus 80% of your energy on the 20% of investments that will move the needle. For most people, that's broad market index funds and maybe some individual stocks in companies you actually understand. Stop wasting time on penny stocks, cryptocurrency gambling, and options trading unless you have a specific, well-researched reason. The complexity isn't worth the marginal gains for most investors. Define your goals, set your risk tolerance, pick your timeline, then build a portfolio that matches. Everything else is just noise. Here's mistake number 5, the one I mentioned earlier that costs investors $200,000 over their lifetime, falling into the day trading trap. The statistics are absolutely brutal. Studies show that 97% of day traders lose money. Not break even, lose money. You're literally more likely to win at a casino than make money day trading. Why? Because you're competing against algorithms that process information in microseconds, professional traders with teams of analysts, and high-frequency trading firms with billion-dollar budgets. It's like bringing a knife to a nuclear war. But here's the kicker. Even if you do make money day trading, you'll pay short-term capital gains tax on every profit. That's up to 37% federal plus state taxes. So you need to beat the market by 40% just to break even with buy and hold investing. The math is simple. A day trader needs to return 40% annually after taxes to match a buy and hold investor making 12%. Good luck with that. Instead, embrace the boring approach that actually works. Broad diversification through low-cost index funds, dollar-cost averaging, and the magical power of compound interest. Let time do the heavy lifting while you focus on earning more money to invest. Mistake number 6 is following advice from people who have no business giving it. Your barber, your brother-in-law, that guy on TikTok with the Lamborghini. They're not qualified to manage your financial future. Here's the harsh reality. Most investment advice online is designed to make money for the person giving it, not you. Those $997 courses promising to teach you secret stock strategies? The only guaranteed winner is the course creator. Social media makes this worse. You see someone post about their big win on GameStop, but you never see their portfolio showing they lost $50,000 on 20 other sure things. The solution is simple, but not easy. Only invest in what you understand. If you can't explain why you're buying something to a 12-year-old, don't buy it. Do your own research, understand the fundamentals, and never invest based on someone else's hot tip. The moment you hand over your financial decisions to someone else, you've already lost. The final mistake is the most expensive one, not maximizing tax-advantaged accounts. This one mistake alone can cost you millions over your investing lifetime. Most beginners start with Robinhood or other taxable accounts because they're easy and trendy. But here's what they don't tell you. Taxes will eat 15 to 40% of your gains every single year. Compare that to a Roth IRA, where your money grows completely tax-free forever, or a traditional 401k, where you get an immediate tax deduction and defer taxes until retirement when you're likely in a lower bracket. Let me show you the math. $500 monthly in a taxable account earning 10% annually becomes $1.04 million after 30 years. But after taxes, you're looking at maybe $650,000. That same $500 in a Roth IRA, the full $1.04 million is yours, tax-free. That's almost $400,000 more for doing literally nothing except choosing the right account type. Max out your Roth IRA first. That's $7,000 annually if you're under 50. Then contribute to your 401k up to the company match. That's free money. Only after you've exhausted these options should you consider taxable accounts. So there you have it. 7 investing mistakes that can cost you your financial future. Stop trying to time the market, minimize fees, build that emergency fund, create an actual plan, avoid day trading, think for yourself, and maximize those tax advantages. Here's my challenge to you. Pick the mistake you're making right now, and I guarantee you're making at least one, and fix it this week. Your future millionaire self will thank you.